The Reserve Bank of India is like money boss of India. It started working on April 1st, 1935. It was established under Reserve Bank Act 1934. Of course, these numbers are not really very important for you. Years. Now, let's talk about what it does. The foremost function of RBI is taking care of money plans. One of the main jobs of RBI is to make smart plans about how much money should be there in the country and how easy or hard it should be to borrow money. This helps keeping prices stable and the economy healthy. The second function is looking after money notes and coins. RBI is like a guardian for money notes and coins. It makes sure there is enough money for everyone and also takes care of printing, spreading, and taking back old money. The third function is watching over banks. It's like a referee for bank. RBI is a referee for banks. It sets rules to make sure banks are doing fair business and don't do any risky things. This helps to keep our money safe. The next function is the teamwork with government plans. The RBI and government work together on money plans. When they team up and work well, it helps make sure prices stay steady and the economy stays strong. So the RBI is like captain of money team, making sure everything runs smoothly in the financial world of India. It's important for keeping our money safe and our economy too. So RBI plays important role in keeping our money and economy safe. Now, one of the function of RBI is to make monetary policy. Monetary policy is like a plan made by Reserve Bank of India. This plan helps them control how much money is there, how much interest we pay, and how easy or hard is to borrow money. Monetary policy is announced at least 4 times a year. Monetary policy committee is there. This committee conducts meeting at least 4 times a year, and the monetary policy is published after every meeting. Now there are three goals of the monetary policy. The first goal is keeping prices steady. RBI want to make it sure that the prices don't go really up too quickly. Okay? There should be some inflation, but it should not be, prices don't should not shoot. Okay? So this way the money we have will retain its value, and we can buy more things with the same money. The second is helping people finding job. So RBI want as many people as possible to have jobs. This makes sure that lots of people have work and can support themselves and their families. Now, how this is achieved? RBI controls the interest rates, and with this interest, new industries can, or with the interest rate, new industry can be set up. Okay, new jobs are created. So RBI looks at the job creation also through indirect way, not the direct way. The next is making the economy grow steadily. It's like making sure that the country keeps moving forward and getting better. RBI want to see more things being made and services being provided, which means people are generally doing well. So RBI's plan is like roadmap to help our economy to stay on track. RBI wants prices to stay steady, people have jobs, and country to keep growing steadily. So these are the main functions of monetary policy. Now, how these functions are achieved through monetary policy, let's see. Through the monetary policy, interest rates are decided. So interest rates is the cost of borrowing money. So when you borrow from a bank, they charge you a little extra for the service, and that's the interest. Central banks like our Reserve Bank of India can change this price to encourage or discourage borrowing. For example, if they want more people and business to borrow and spend, they might make borrowings a bit cheaper by lowering interest rates. This makes it more attractive to borrow money. The next is open market operations. Through monetary policy, open market operations are controlled. Now, what is open market operations? Government bonds are generally bought by commercial banks and financial institutions. or high net worth individuals. All these entities maintain account with the bank, and whenever these entity purchase the bond, the amount get transferred to the central bank. Thus it can be said that open market operations have an impact on deposit and reserves of the bank, and they play a role in their ability to provide credit. When central bank means RBI want to reduce the ability of money to public, it will sell government bonds, means bank have to buy the bonds. And so bank has to buy the bonds, so they have to pay price. So this money goes to the reserve bank, central bank. So this steps reduces the money supply in the economy and restricts banks to offer credit to the individuals. Thus money supply in the system reduces. Similarly, at times when liquidity conditions are tight, there is no liquidity in the market, there is no enough money in the market, RBI buys back the securities, and this gives the commercial banks and public easy access to the credit facilities that helps in injecting liquidity into the system and establish the market. So when RBI buys the security, what will happen? They will pay it to the bank. So bank will have more money. So more people can borrow money from bank. The next is reserve requirements. So how the money supply is controlled. So you have to keep a certain amount of money in the bank vault. Central bank means RBI decide how much money this should be. So if you raise this amount, it means bank have to keep more money in their vaults and can lend less. So every bank cannot lend all the money it has got. So it has to reserve some portion of the money. So if the bank has, let's say, 100 rupees, it can lend only 50 rupees to the people. They have to keep it, they have to keep remaining 50 rupees in their vaults. So this proportion can be changed by Reserve Bank. So if they lower it, banks can lend more money. So if they make it 75%, means 75% money you can lend, then bank can keep only 25%. So more credit is offered by the bank to the public and more money in circulation. So these tools are like levers that RBI can pull to manage the flow of money. Now people often thinks that why don't we print more currency and distribute to the people to become rich? Okay? The answer lies in the value of currency. More is the number, less is the value. Like water is precious in desert area and sand is precious in others. So let's understand the effect of printing more money. So this is the question. Generally, people think why should we are not printing more money to give it to the people. So if more money, there will be more demand. So when there is a lot of money available for people to spend, they usually buy more things. This makes business busy because everyone wants to buy their stuff. When business are become very busy, they might raise the prices for goods and services. So inflation increases. The next is demand pull inflation. Imagine you want to buy a certain smartphone, but there aren't enough smartphones available in the market. So and many people want it. So what happens? Prices goes up. So this is what happened in demand pull inflation. When many people want a thing and there is a scarcity, then prices goes up. So RBI, which is like a money manager of the country, want to find the right balance. They want there will be enough money in the market so that people keep buying and economy keeps growing. But they also don't want there to be too much money because that could lead prices shooting up really fast. Now, how interest rates are decided? When you apply for a bank loan, they will tell you certain interest rate. Now these how these interest rates are decided. Okay, interest rate in the country are almost similar for a particular sector of lending agencies. Like if you apply for a home loan interest rates are generally similar, auto loan interest rates are generally similar, personal interest rates are generally similar. Like all nationalized banks has similar rates of interest for home loan. These rates are decided by the monetary policy. Now interest rate are is like a price tag on borrowing money. It's like when you borrow a toy from friend and you promise to give it to back later. Interest is like a small extra toy you give back as a thank you. Okay. The RBI, which is like the money manager of our country, uses something called as monetary policy to decide how much should be the cost to borrow money. They should do this to keep things balanced in the money world. Now, how these interest rates are decided, or how what are the tools used by RBI to decide how much should be the cost of borrowing money? RBI uses some special tools to control how much money is floating around. Okay, so if less money is floating around, okay, more will be the demand, more will the interest rate. So more money is floating around, interest rate will decrease. So RBI doesn't directly control the interest rates. RBI controls the amount of money available in the market. Of course they also decide the minimum interest rate, but maximum they don't quote. Okay, they use tool like repo rate, reverse repo rate, cash reserve ratio, and statutory liquidity ratio to do this. These tools help them decide how much money to let in or take out of the money system. Now, what is repo rate and reverse repo rate? Repo rate is like RBI lending money to the banks for a short while, like a friendly loan. Our bank promises to give back the money with bit extra, means interest, after a short time. The RBI does this mostly using government securities as a guarantee. So RBI keeps government security as a guarantee and gives the money to the bank to lend it to the people. Now reverse repo rate is like RBI borrowing money from the bank. So if banks keeping money in with the RBI, okay, RBI plays some interest rate, and this is decided by, or this is controlled by, the reverse repo rate. Now there are few more tools that is used by RBI to control the money supply. One is SLR, called as statutory liquidity ratio. It is like a special rule for a bank. It tells them that out of all the money they got from the people, they have to keep part of it in a very safe and easy to use form. This safe form can be actual cash like coins and bills, gold, or government securities like special promise to pay back. So if bank has got certain amount, let's say 100 rupees, out of that 25%, this is just an example, okay, 25% they have to keep in the form of cash, government securities, or gold. So this ratio is decided. So bank will have, if this ratio is more, bank will have very less money to lend it to the people. The another tool is called as cash reserve ratio, is like a rule book that says bank must set aside a certain amount of their total money and give it to RBI. This money stays with RBI in the form of cash. It's like a bank putting some money in special savings account. Okay, so CRR, cash reserve ratio, is let's say 50%, then it's not 50%, it's generally 5 to 10%. So 5 to 10% of the total money of bank should be kept in reserve bank account. Okay? And reserve bank pays the interest rate on that. So RBI uses tool like repo rate, repo rate, SLR to manage how much it costs to borrow money. It's a bit like using special stick to control the game. If they want people to borrow less, they will use one stick, and they want to encourage borrowing, they use different stick. When they increase the repo rate, it's like telling people, if you want to buy money, you will have to give more interest rate. Okay, borrowing money becomes bit more costly, so people might think twice before borrowing. And if the interest rate are less, okay, so people will borrow more. You might have heard about one term at the time of budget of the country, that is called as fiscal deficit. Now what is it? Fiscal deficit is a crucial economic indicator that reflects the shortfall when government total expenditure exceeds its total revenue in the given fiscal year. So it's basically a difference between government earning and government spending. Government earning is through taxes, and government spending is in the form of infrastructure, healthcare, education, etc. etc. Now, fiscal deficit plays an important role in economic policy making. It provides insights into the government fiscal discipline, sustainability of finances, and potential impact on the broader economy. So, if the government spendings are more than the revenue, there will be fiscal deficit. Now, what are the components of fiscal policy? The components of the fiscal policy is total revenue. Total revenue is like money that government collects, which includes the money they get from taxes, other sources of income, and special fund they receive, like funds from IMF, International Monetary Fund, or World Bank. Then total expenditure. This total expenditure is the money government spend. It covers everything from building new things like schools, roads, running day-to-day operations, salary of government employees, and other things. And borrowings is when government doesn't have enough money to cover all its spendings. It borrows money from agencies or people like us. So government securities is nothing but government borrowing money from people. It's like asking for loan. They can get this money from people and institution within the country or from other countries, like a country takes loan from the World Bank. So it's borrowing. Now let's simplify the significance of fiscal deficit. Fiscal deficit is the deficit between government spending and government earning, government revenue and government spending. So think of fiscal deficit is like a seesaw for government's money. If the deficit is too high, it can lead to problem. Similarly, high fiscal deficit can make prices go up quickly, means inflation, and make the economy bit shaky. So if the fiscal deficit is too high, means if government earning is short than the government spending, then government will put more money into the market or government will borrow more. As government borrow more, it will cause problem to the entire economy. Now, fiscal deficit also affects how much government needs to borrow. If the government has a high deficit, it means they need to borrow more money. Okay, this can make borrowings more expensive for them. So fiscal deficit is like a signal to show that how well the government is handling its money. If it is too high, it can make things shaky and borrowings harder. It's like trying to balance of the things. So there will be always going to be fiscal deficit, but it should not be too high. Now, what are the causes of fiscal deficit? Let's see. The causes of fiscal deficit are shown on the slide. The first is public expenditure. Think of public expenditure as a money government spends to make things better for everyone. This includes things like helping farmer, building roads, infrastructure, and providing healthcare. When government spends a lot of on this thing, it can lead to a high fiscal deficit because they are using a lot of money they have. The next is tax revenues. When people buy things to earn money, they have to pay a little extra to the government. That is called as tax. If it's hard for government to collect this tax, they don't get as much money as expected. This means the government has less money to cover their expenses, which can contribute to the fiscal deficit. Now, if country's economy is growing bigger and stronger, okay, that's good. But when the economy grows, the government might also need to spend more. Okay, this is because they want to make sure everyone benefits from the growth. They have to build new infrastructure. Okay, they have to spend more on education and healthcare. So while economic growth is great, it can lead to higher government spending, and this can affect or this can create a fiscal deficit. Now this slide shows the trends in fiscal deficit over last few years. You can observe the fiscal deficit is almost 10% of GDP during COVID period, when government had to spend a lot of money to handle pandemic situation. To meet the government this deficit, government borrow from World Bank, International Monetary Fund, or issues government securities in the market. Now, as I told you, the government always try to reduce the fiscal deficit because it can create problem. So these are the ways the government reduces the fiscal deficit. The first is subsidy reform. Think of subsidies like discounts. Sometimes the government gives discounts on things like food, fuel to help people. But if these discounts are too big, they can strain the budget. So the government might review and adjust this discount to make sure they are fair and not too costly. The second is GST implementation. GST is like a simplified way of collecting taxes on goods and services. It makes sure that everyone pays their fair share. This helps in increasing tax collection, which can contribute to reducing the fiscal deficit. The next measure to control the fiscal deficit is disinvestment and asset monetization. So if you have, imagine you have more valuables than you needed. You have, let's say, two cars and you need just one. So what you will do, you will decide to sell one of the car. Similarly, government can sell some of its assets like shares in the companies or even land. This brings extra money which can be used to cover the expenses and reduce the deficit. Next is expenditure rationalization. This is like going through your spending and cutting down on things you don't really need. The government does something similar by reviewing its expenditure and making sure they are necessary and efficient. The next measure is targeted public spending. Instead of spending on everything, the government can focus on specific areas that need the most help. It's like directing your pocket money towards things you really want or need rather than spending it randomly. The next measure is tax reform. Sometimes the tax system needs makeover. The government can review and change tax rules to make sure there is a taxes are fair and people will readily pay taxes. Okay. The next is improved tax administration. It's like having better system in place to collect taxes. It ensures that everyone who owes taxes actually pays them. Okay. In India, a lot of people owe tax, but very little people or very few people pays the tax. This can help in increasing the money coming in and reducing fiscal deficit. Now these are some conclusions of this lecture or this topic. GDP is one of the indicator of growth of economy. Per capita income reflects the financial wellness of people rather than GDP. So GDP is not a sole indicator of country's well-being. Moderate inflation is always a sign of healthy economy. Interest rates are decided by the monetary policy of the country. There are tools to decide the interest rate. Tools like CRR, means cash reserve ratio, repo rate, reverse repo rate, statutory liquidity ratio are the tools used by RBI to control the interest rate. The difference between government spending and earning is called as fiscal deficit. Government takes different measures to control the fiscal deficit. So this is about the things you need to understand about macroeconomics. In the next lecture, we will study about microeconomics. So thank you for your attention. We'll see you in the next lecture. Thank you.